Welcome back to the Fresh Economic Thinking podcast. You're in for a treat today. I have Stephen Hale with me for a chat. You might be wondering, of course, who's Stephen Hale? Well, I met Stephen. He invited me to a modern monetary theory conference a few years back in Adelaide. He's a terrific guy, so I wanted to have him on the podcast to learn a bit more. Stephen, thanks for coming.
Well, thanks for asking me, Cam.
So I just wanted to get a bit of your story as a bit of background for the listeners. We were talking off air about you working in training bankers for many years and then becoming an academic. What's the Stephen Hale story, and how does modern monetary theory fit in with your sort of intellectual journey? Is there a Cliff's Notes version of that story?
Well, I guess, like a lot of people, I studied economics at university. In my case, it was at the London School of Economics more than 40 years ago now, because I thought I was going to learn how the world worked and be a force for good. By the time I'd spent 4 years there and done my master's degree, I worked out that actually I wasn't really learning how the world worked, but I also worked out that economics isn't that hard.
Right.
So to be honest, I spent most of, at least the first half of my career, not thinking of myself as an economist, but thinking of myself as an economics teacher. Finance was deregulated in London in the mid-1980s. And there was a big explosion in the finance sector. There was a lot of employment to be had, training bankers. And I did that for 15 years. In terms of where MMT came in, towards the end of that period, I got to train some sometimes quite senior bankers. People had started off at the bottom and worked their way up and go on to the board of directors or close to it, as far as medium size, occasionally bigger banks were concerned. And they'd been told by the Bank of England that they needed to qualify, they needed to do the Chartered Institute of Bankers exams. So they ended up in my monetary economics course. And I taught all the mainstream stuff. And on several occasions, I had people say to me, "Thanks very much. I'm sure what you've taught me will help you pass the exam. But you do know it doesn't work like that, don't you?"
Wow. That's
and
interesting.
I dismissed it at the time. It wasn't until I came to live in Australia and got some work at Adelaide Uni, which still had some post-Keynesian economists in those days. That's economists who take money and finance and realism a little bit more seriously than the neoclassical mainstream do. And been introduced to the work of people like Bill Mitchell at the University of Newcastle and the other leading MMT economists, that it gradually seeped in that some of those bankers that I'd met in the 1990s had got something worth listening to tell me, and that I've been wrong to ignore what they had to say. I can't tell you when I started calling myself an MMT economist, because I can't remember exactly when it was. It would have been about 20 years ago at some point. And then I sort of went public with it, or at least stopped teaching what I had come to see as being largely nonsensical immediately after the GFC broke out in 2008.
Yeah, interesting. Wow, that I didn't actually know that story. And it's funny because I guess my economics journey is quite similar. I guess you do your standard degree, you think you know stuff, and then you encounter people who are experts in an area, and you gradually learn that, yeah, that sort of conflicts with what I learned. I'm going to have to dig into that. And just like you, I started dropping out teaching macroeconomics. I sort of replaced it with the Reserve Bank has some great material on how banking works and settlement of banks work. And they've, the Bank of England does too. So I substituted that out, because you can't just go on teaching because it's in the textbook if you know that that's not relevant to the modern monetary system. So I don't even know if we've mentioned MMT as modern monetary theory. So what I would credit you, Stephen, plus Bill Mitchell and Warren Mosler and Stephanie Kelton with um, forcing me to reconsider that view that I learnt in economics. And then when the Bank of England and the Reserve Bank comes on and says similar things, you really have to sit up and pay attention. So what is the biggest, I guess, difference? So if you're going to tell someone now what you've learned in this textbook in economics is not quite right and doesn't give you insight, here's a modern monetary theory version, which should just be economics, should just be standard economics version of banking and money. What's the sort of core difference in the insight you get about how the world works or how, economies work? Is there a like sharp,
There's
pointy, big,
yeah, there's
big
lots
insight?
there's lots of them, Cameron. Sorry
Okay.
to interrupt, but
Yeah.
if I was talking about teaching economics, as you'll know because you've seen the movie that's advertised behind me, if
Yeah.
anyone was watching the video, Finding the Money, the very story about the historical emergence of money in the first place and what
Right.
money is, that we were all taught at university, and we all swallowed unquestioningly the idea that at some point in ancient history there were barter economies where people traded essential items, exchanged
Mm-hmm.
good for goods, and then over time it was realized that this was a very inefficient way of organizing transactions, and so some commodity was used as a general means in exchange for goods and services, and that was often a precious metal like gold or silver. The fact that that's completely wrong, there's no evidence that that ever happened even
Yeah.
once anywhere in human history. And
Yeah.
yet it is still in all the mainstream textbooks today. And the fact that it's been known that this is wrong, well, with increasing certainty, but
Yeah.
largely speaking, it's been known it's been wrong for about a century
Yeah.
now, and it still continues to persist. The idea that money was invented in the private sector as a means of saving transaction costs in a barter system, when in fact, as far as we could tell, money was invented by the earliest governmental institutions,
Yeah.
and money is that which is necessary to pay your taxes. That's what government currencies are. Or if we're talking about private bank money, we accept that as money because we can exchange it for that which is necessary to pay your taxes. That leads on to it being important to distinguish between currency issuers and currency
Ah, yes,
users.
that's right.
And
S-
currency users like you or me or a business or a state government have to find dollars before they can spend them. And we have to be very careful to avoid running deficits for too long. Otherwise, we run up debts
mhm.
which become difficult to service, and we take the risk of becoming insolvent. If you're the currency issuer, it's not the case as far as you're concerned at all. And in fact, rather than having to go and find dollars before you can spend them, you have to spend dollars into existence
Yeah.
before the private sector can get those dollars and use them, including to pay their taxes to you. So for a currency issuer, the spending comes first. And if we're talking about the government, you can't tax dollars that you haven't spent into the system previously. So you
Yeah.
spend first, you tax later,
Yeah,
and you
that's
never have to go and look for dollars before you can spend them. But if I
yeah.
was putting it in a nutshell,
Yeah, yeah.
um, what does the mainstream say about
Mm,
the government budget? They say fiscal deficits are unsustainable, or at least could be unsustainable if they drive the debt to GDP ratio up over time. And what we'd say is it's not deficits that are unsustainable, it's government surpluses that are
mm,
unsustainable, because deficits involve the government making a deposit in the monetary system, which is then available for the private sector to save and have strong balance sheets. Surpluses, where they
mm.
tax more from our bank accounts than they spend into our bank accounts, drain financial assets from the private sector, weaken private balance sheets, drive the private sector into debt, creating more fragile financial system, or drive the economy into into recession.
Yeah.
And this is obvious when you look at the data. Anyone can go on the IMF site and look up the data for government balances of the 39 countries that the IMF classifies as advanced economies. And if you do that every year since 1990, when they
Yeah.
started producing this data, governments have been on average in deficit. There's a very good reason for that, which is that the private sector needs to be in surplus for the monetary system to work properly. And the private sector cannot globally be in surplus unless the government sector globally is in deficit. So on average, governments run deficits. This is nothing to be scared of. It's just the difference between two numbers. It's the difference between what the government spends into our bank accounts and what they delete from our bank accounts in taxation. That's a
So
completely different story to
that
what you
is a
get from
different
the mainstream.
story. So how does so just to sort of tie a bow around this point, there's currency issuers and currency users. Money is not an emergent commodity that we just pick out of all the commodities to barter with. It's actually a credit arrangement that is sort of born of a state, right? So the state tells you what money is good and what whose credit is good, and therefore the state as the issuer of this currency should be over time issuing more currency to people and is running a deficit, a public deficit, so not taxing everything they spend, but making sure there's a little bit left over to add. And so policies that attempt to engineer the repaying the debt are essentially misunderstanding the economy and ending up with the consequence of um, shrinking private sector balance sheets and then contracting the real economy. Is that a good summary? Just to sort of
Absolutely right.
reflect back
Yeah.
what you said. Great. Yeah.
Unless you run large persistent trade surpluses, if you're Norway or Singapore, you're exceptional. In that
Right.
case, the government may need to run surpluses in order to prevent total spending on what's produced in those economies going beyond the productive capacity of the
Yeah.
economies and being inflationary. But on average,
Yeah.
if governments run surpluses, then the private sector runs a deficit. You can do that for a while if you start off with a low level of private sector debt and strong private balance sheets, as was the case when John Howard came to power in Australia, where
Yeah.
the government ran a surplus 8 years out of 10. But the consequence of doing that was that we went from a very low level of household debt to GDP in Australia
Yeah.
in the mid-90s to the world's second highest level by the time that John Howard
So so
left power. So either the private sector has to go into debt to support the economy, or you'll have a recession. And if you have a recession, the government balance will go back into deficit anyway.
yeah, I do always point to people, what about Japan, right? Everyone has these stories. So let me take the next step. There's a lot of the mainstream story is that if governments try to spend too much because that means that they issue a lot of bonds, and because there's a finite capacity for the market to buy them, the price falls, so the interest rate rises if they try to spend more. That was in the book Finding the Money, in the film Finding the Money, and I recommend all listeners go and find that film. it's uh, it's it's really like I have pretty high standards as an academic economist of how to communicate ideas, and that was exceptional. As I've said, so go find that. But one of the ideas was this confusion that if governments run deficits, like they spend more than they tax, therefore they're creating money, that somehow changes the interest rate in the economy, and that then therefore has a perverse consequence. Why is that not the correct story? Because that's the standard story, and I think most policymakers in most countries believe this and act as if it's true.
Yeah, and if you put them in front of a camera and ask them to explain it, they make fools of themselves, as Jared
Exactly.
Bernstein did in the movie, who's President Biden's advisor, and also Jason Furman, who had the same job when Barack Obama was in power. Yes, it's the loanable funds fallacy, which bizarrely Keynes explained was a fallacy 90 years ago, but is remarkably persistent. The notion that there's a fixed amount of private savings out there, and if the government comes and borrows some of those private savings, then that means they're not available to fund private sector investment spending. And what will happen
Yeah.
is more government borrowing will drive the interest rate up. Of course, again, the mainstream has got that precisely the wrong way around,
Hmm.
because it ignores or abstracts or misrepresents the monetary system.
Yeah.
And government deficits provide the dollars that allow the private sector to save. So the government is not using up a fixed amount of private sector saving. The government is providing the dollars which allows the net saving to happen in the private sector in the first place. And when the government auctions treasury bonds, and we have got into the habit of approximately cancelling out deficit spending by the federal government through
Yeah.
the issuance of treasury bonds, only since the early 1980s. We didn't do it that way
Yeah.
before then, but we've got into that habit. What the government is doing when they auction treasury bonds is just absorbing dollars that they've previously spent into the system.
Yeah.
That's all that's happening.
So you're
And,
printing money by the deficit, and then you're saying, "Whoopsie daisy, we want it back now, so we'll swap you back this different thing that's not money. It's called a treasury bond for that other thing that's called money or a deposit account."
and it was understood when we transitioned to the system we have now, approximately the system we have now, in the early 1980s. It was understood what the purpose for this was. At the beginning of the 1980s, interest rates were deregulated in
Uh-huh.
Australia, and it became very important that the Reserve Bank of Australia was able to manage the supply of cash liquidity to private banks, to ensure that private banks didn't have too much liquidity, in which case the cash rate, the overnight interest rate, would fall below the RBA's target for it. When the government deficit spends, it
Hmm.
makes deposits in our accounts with our banks. It also makes, at the same time, makes deposits in our bank's reserves at the RBA.
Hmm.
And if you engage in deficit spending without auctioning treasury bonds, then you're flooding the banking system with cash, and you drive the cash rate, at least this was the story prior to the pandemic,
Hmm.
below the Reserve Bank's target. The Reserve Bank loses control over
Uh-huh.
the cash rate downwards because you flooded the banking system with cash. So the
Yeah.
reason for auctioning treasury bonds to absorb that surplus cash was to prevent the banking system being flooded with cash and the RBA losing control of interest rates, not upwards, but downwards. Now,
Sure.
this is actually described in a history of treasury bond issuance, which anyone can read, which is on the Australian Office of Financial Management site. So it was understood in 1982. It's somehow not widely understood
What?
now.
I'm gonna have to look that up, um, or you'll have to send me a link afterwards, and I'll put it in the show notes.
Absolutely
Because
easy.
let me be clear. In the film Finding the Money, there was some interesting interviews that said if governments can print money, why do they issue debts? Because they're just getting back the money that they can print.
Yeah, we don't
Okay, and
like
so
it. We don't like saying print money. And the
but
other thing that we'd like to
crediting
point
accounts,
out
we'll call it, maybe.
is
How do you?
there's only one way for the government to spend. The government always spends through currency issuance. There is no other way
Correct.
for the federal government to spend. It's then what you do next.
Yeah. That's right. And I think that's one of the insights that I got from you and other MMT economists is that the spending process is independent. It doesn't actually rely, treasury issuance of bonds is a completely different thing and they're unrelated. They're both choices independently. And once you realize you don't have to, like, it's not one choice to sell a bond and spend the cash you get. It's actually you spend as needed. Treasury just credits accounts and then you manage the bond market as well as needed, right? They're completely independent, and that actually was something for me. The ability to separate that allowed me to think better, and so maybe that will help
Yeah.
some listeners.
And
So,
going back to the very beginnings
mhm,
of a currency, as Warren Mosley says in the movie, is useful there. You couldn't sell treasury bonds, just as you couldn't
yeah,
tax people unless they had the
yeah.
currency in the first place. So you have to spend it
So
before you can withdraw it again in taxation or
exactly.
as a result of bond issuance.
So I just want to solidify that point a little because in the film, who was the character who was asked, why does, if Treasury can just print money, why do they need to sell bonds? And so your
That
answer
was
is
Jared Bernstein,
right, and your
who
answer is
is the
well,
chief economic advisor of President Joseph Biden.
yes, exactly. It was very entertaining, but the
Mm.
your answer is that historically, the use of bonds was to manage interest rates to control, so that the central bank doesn't lose control, like to drain exchange settlement funds, we call them in Australia, to drain reserves.
Yeah,
But that's not the case anymore, is that right? Because we've been flooded with reserves and still
it
control the
was
interest rate. Is that how has
absolutely.
that changed?
It wasn't the case originally either. I mean, if you were to go back into the distant past when there
Oh
was a
wow.
gold standard,
Uh-huh.
then then you had to be careful how much of your currency you spent into existence because you guaranteed, as part of being in the gold standard, having
Uh-huh.
in
The
that fixed exchange rate
convertibility.
system. That's right.
Yeah.
But the Australian dollar went off gold, I think, in 1933. So that's
Hmm.
rather a long time ago. Even under a fixed exchange rate system, though, you are theoretically guaranteeing that you'll exchange your currency for a foreign currency
Ah,
at a fixed exchange rate. You can run out of foreign currency. But we've had a floating exchange rate since 1983. That was part of the deregulation of the Australian financial system, which began in the early 1980s. And that's the story that I was just telling you about
yeah.
there. From then on, Treasury bond issuance was about draining excess reserves for the banking system to allow the RBA to keep the banks a little bit short of cash. And this is what they did all the way up till March 2020. Keep the
Yeah.
banks a little bit short of cash, and then you lend to the banks just for a few days, just
Mm,
keep topping them up. And the terms under which you're prepared to lend to the banks to keep
yeah.
them topped up with liquidity gives you the ability to control the overnight interest rate that we call the
Correct.
cash rate.
Mm,
You're absolutely right. This changed in March 2020.
yeah. So what was that
Um,
change?
what happened in March 2020? Well, first of all, here's another sort of insight from MMT.
Yeah.
We go into the pandemic. Uh, During the pandemic, the government engaged in, I think it was about $340 billion in total of deficit spending.
Yeah.
They announced that they were going to be prepared to do at least half of this right at the very beginning. Josh Frydenberg said, no question, we have no problem doing this. So we had JobKeeper, JobSeeker, and everything
Mm-hmm.
else that they announced. Now, how are they going to fund this huge amount of deficit spending in March 2020? You might say, well, they need to borrow the money. They'll have to issue some treasury bonds. But the only way you can buy
And
treasury bonds when they're first issued in Australia is to use funds in banks' exchange settlement account balances. There were hardly any funds in
uh-huh.
bank exchange settlement account balances in March 2020. The money to buy the
All the
Treasury bonds to fund the government's deficit spending literally did not exist
mm-hmm.
in March 2020. And yet, Josh Frydenberg didn't even have to have a second thought when it came to going ahead with the spending.
Yep.
How did it work? Well,
Yeah.
the easiest thing would have been for the RBA just to credit the official public account to allow the Treasury to engage in its spending and to take Treasury securities, Treasury bonds from the government just to record as assets on the RBA's balance sheet. But of
Mm-hmm.
course, we tied ourselves in knots with the way we think about our monetary system. So that's not how they did it. Instead, they engaged in, as everybody knows, large scale quantitative easing, which basically meant that the RBA bought existing Treasury bonds on the
Uh-huh.
second-hand market, feeding the cash into banks' exchange settlement account balances, which was then available for those banks to buy the Treasury bonds
Back with.
that the government issued
Yeah.
in order to feed the cash into the official public account, which could then be spent and put back into private banks' reserve accounts again. So
Yeah.
that's how it all worked. It's unnecessarily complicated because of this habit that we've got into now of matching uh, net spending by the Treasury with Treasury bond issuance. And
Mm.
that habit goes along with the practice of not having the RBA buy government debt directly from
Directly.
the government, which has been the case since 1982. Prior to that, the RBA used to issue Treasury bonds on behalf of the government at interest rates that the RBA was happy with. And if there was a lack of demand in the private sector for those bonds, the RBA just bought them. They
Yeah.
stopped doing that in 1982.
Uh-huh. So these days we can, but so just to be clear, we can still manage the cash rate if the government deficit spent and didn't issue more treasury bonds today.
Yeah, which is effectively what was happening during the
Yeah.
pandemic. The deficit spending during the pandemic and the RBA's holding of government bonds or the increase in the RBA's holding of government bonds were almost exactly the same.
Yeah.
So it was as though, and when you look at the final
It-
position,
oh,
it
yeah, I
was
see
as
what you're
though the
saying.
RBA had just credited the government's account and
Yeah.
taken treasury bonds from the government. They just did it in a
And
more complicated way. But that's
right.
what happened
Yes.
effectively. And yes, that doesn't mean zero cash rates because, of course, for years now, the RBA has paid interest
That's
on
right.
bank reserve balances. And so
That
what happened is the overnight interest rate just fell towards the rate that the RBA pays
right.
on
So
bank
the
reserve
RBA
balances.
now pays interest on these exchange settlement balances, which are the bank reserves. So it's the
Yeah.
accounts our bank has at the central bank, but they also charge interest if a bank needs to borrow them temporarily from another bank. Is that or from the RBA? Like there's a corridor
No,
now. No?
yeah, there is a corridor. Um, uh, at
We're getting into
least
the
prior
weeds.
to the
Let's
pandemic, well,
yeah.
there are millions of transactions that take place, that everybody knows, every day in
Yeah.
Australia. And so, as a consequence of that, there are funds transferred between the banks
Yeah.
using their exchange settlement account balances at the RBA.
Hmm.
So, if there's a transfer of funds out of the Commonwealth Bank and into the ANZ on a particular day, the Commonwealth Bank's exchange settlement account will be debited and the ANZ's will be credited. Now,
Hmm.
prior to the pandemic, banks didn't hold very much in the form of exchange settlement account balances. So, in
Yeah.
order to allow the system to continue to work day to day, banks that were receiving funds lent those funds overnight to banks that were short of funds. That's
Yeah.
basically how it worked. And the rate of interest at which that happened, which, or the average rate of interest every day at which that happened, and theoretically at least, was not set by the RBA, but was a market rate and was called the cash rate.
Uh-huh.
The RBA has a target for the cash rate,
Yeah.
but at least in principle, the RBA doesn't set the cash rate, even though for 20 years prior to the pandemic, it was always precisely what the RBA wanted it to be. So there's a degree of pretense there. Then you have the pandemic breakout, and you have, for reasons we were just talking about, you have the banks ending up being flooded with reserves. And over the next 2 to 3 years, a lot of the time there was no overnight interbank market because all the
Uh-huh.
banks were flooded
Yeah.
reserves. Nobody needed to borrow
Exactly.
from anywhere else. They still published a cash rate. When they did, it was sometimes what the overnight interest rate was last time there was any significant overnight lending, so from
Oh.
several days ago, or sometimes they announced a rate which was set by a panel of so-called experts.
Hmm.
Um, some of the smaller banks were still borrowing overnight, so there were still some transactions, but the market was tiny and almost disappeared. And that's not quite so true now as it was then, although there's still large amounts of excess reserves. Gradually, as treasury bonds mature and are
Hmm.
being treasury bonds that RBA holds mature and are being rolled over as the government is issuing more treasury bonds, which are being bought in the private sector. Gradually, bank reserve balances are being drained back a little bit, so there's more
Hmm.
overnight borrowing now than there was previously. But it's
Mm.
still the case that the average overnight interest rate is not the same thing as the RBA's target for the cash rate and is a little bit below it.
Right.
Um,
Interesting. So I want to, before we sort of get to some wrapping up and let you sort of promote the Modern Money Lab and what you're up to now, a couple of quick questions that I think um, are interesting. One of the big ideas circulating in MMT now is that higher interest rates, so the central banks increasing interest rates, can increase spending in the private sector rather than decrease it. Like the mechanical effect we think happens in the standard theory that everyone stops spending or stops borrowing because the interest rate's high might not happen because interest is someone else's income in the economy. So I pay interest to the bank. Bank shareholders now get a bigger dividend, but they're going to spend. Is that roughly the story that in the standard theory interest disappears? You pay, like, you're borrowing less, you're spending less, but in the MMT story, it's sort of a closed. You're always looking at the other side, and so that interest is someone else's income who can spend. Is that?
well, there's a terrible muddle in mainstream economics about the impact of higher interest rates, actually, which we'll
Mm,
come to in a minute. But when you think about an increase in interest rates, what are the impacts? What are the ways in which that can be transmitted to the
mm,
economy so that there's a link between monetary policy, the RBA's interest rate decision, spending in the economy, and inflationary pressures? There's a variety of influences. Of course, there are. So higher interest rates can discourage people from borrowing so much, could in principle discourage business investment, although
mm-hmm.
there's very little, if any, evidence of that significant in practice.
Yep.
Higher interest rates, as you were just saying, redistribute disposable income. So if
Mm-hmm.
you are a variable rate borrower, you're going to have less spare cash now. But if you're an old person like me with a term deposit, you're going to have more.
Yep.
Some people lose, some people gain. Higher interest rates might put downward pressure on asset prices, although small increases in interest rates don't seem to have a very considerable impact. But
Yep.
higher rates, at least in theory, ought to put downward pressure on the stock market. Other things remaining equal, that's what the standard theory would say.
Yeah,
Interest
exactly.
rates can have an effect on exchange rates, and so on the ability of exporters and trade exposed sections
Yeah.
of the domestic economy to compete. All those things you might imagine might slow down spending, even the redistribution, because in general, people who have net debts might have a higher propensity to
Mm-hmm.
consume than people who have high levels of
Savings.
savings.
Yeah.
But on the other hand, the biggest payer of interest in the economy,
Oh, yeah.
and this is less true in Australia
Yeah.
than it is in the US or Japan, is the government.
Right.
And so this is what Warren Mosler
Right.
talks about, particularly in a US context. The US government budget deficit has increased significantly over the last couple of years, and at least half of that has been the simple consequence of rising interest rates, because
Right.
higher interest rates means a bigger fiscal transfer from the government to the private sector, and those interest payments might be going to bondholders who may have collectively a low marginal propensity to consume, but it's not zero. And
Yeah.
potentially that can have a positive impact on total spending. And in the US, that seems to have happened. It
Yeah.
depends on the state of private and public balance
Got it.
sheets. And it also depends on things like how the mortgage market is organized, because, of course, in the US, most mortgages are fixed rate
That's right.
mortgages. In Australia, they're variable rate mortgages. So it's a little bit more complicated than people make out. But
Right.
the main point we're making is that there is no simple, stable, predictable
Relationship.
link
Yeah.
between interest rates and total spending in the economy, and the relationship can be a perverse one. Warren sometimes
Yeah.
simplifies this just to
Yeah.
provoke people,
Yeah.
I think.
Like I think that view makes a lot more sense because I look at the history of interest rates and all through the 2000s interest rates were rising and the economy was booming. Like some people say, well, we increased them because the economy was booming, therefore you get the correlation. But the fact that the effects are ambiguous at different points in the cycle or with different settings for the bond market and the mortgage market, to me seems to match a lot better what you observe. So
And what
I want
about after 2010 too, when we kept cutting
to,
interest
yeah,
rates to
we
try
did
and
for a
try and
decade.
push inflation up, and it didn't work?
All right, I got a quick question, and then I want you to share where people can find your writing, what you're doing at the Money Lab, and it is this: is the belief that the government budget is binding a useful political tool because there is a resource constraint. That's the good thing about MMT. Is the budget constraint a good enough proxy for all the dumb politicians out there to not do silly things? Or do you think that's constraining our policy space too much?
I think it's important that people understand that governments in countries with monetary systems like ours face no purely financial constraints on what they're able to do. But they face, of course, they face a real resource constraint. We've got limited amounts of labor and skills and capital equipment and technology, institutional capacity, and obviously materials too. So there's a limit to what we can produce. And so all spending carries an inflation risk, particularly when you're close to full employment. So we're not removing the limits or anything, but
Mm-hmm.
it's vitally important that we understand that this has got nothing to do directly with the state of the government budget, or at least that you can't interpret whether
Yep.
a government budget is balance is appropriate or not, taken out of context of the economy generally. It's important to understand that governments of countries with monetary systems like Australia's
Uh,
face a real resource constraint, but no purely financial constraint. They can't run out of their own currency. They can run out of things that they can buy with that currency without driving the price level up anyway, because we've got
yep.
limited productive capacity. So if total spending goes beyond the productive capacity of the economy, it's going to put upward pressure on inflation. Nobody likes that. So we're not about removing the limits. But where
Yep.
this is important, or just to show how this can be important in Australia, is that after the global financial crisis, the Kevin Rudd, Julia Gillard government rapidly um, moved back towards wanting to push the government budget into surplus. I can remember saying to my class at Flinders University at the time, this is
Yeah.
going to cost them the next election.
Yeah.
I know the carbon tax thing made Julia Gillard unpopular and didn't help. But what also didn't help was they kept promising that next year there'd be a surplus. And I was saying to my class, well, given private sector behavior and given our relationship with the rest of the world at the moment and looking at the state of balance sheets, it's almost impossible that this is going to happen. So they're going to fail to bring it about. And at the same
Yeah.
time, the policies that they're going to implement to
Yeah.
try and make it bring about will guarantee that we'll have higher unemployment and underemployment than we need, and we'll have worse public services than we could have done. Inflation for most of the decade leading up to the pandemic was below the Reserve Bank's target range, even with interest rates being cut towards zero.
Yeah.
We had higher unemployment than we needed to have,
Yep.
much higher underemployment than we needed to have.
Yeah.
Um, we could have made investments in infrastructure, in a more rapid transition towards renewable energy, in healthcare, in education, as long as the real resources, the skilled labor, the technology, materials, whatever else we would have needed to do so existed. We could have made those investments. We could have had a more successful economy. And the reason that we didn't was because the people who were advising Kevin Rudd and Julia Gillard, in my view, um, are trapped
Yeah.
within, or certainly were trapped within neoclassical blinkers. They thought that the important thing was to avoid a structural fiscal deficit,
Hmm.
to get the budget back into black as quickly as they possibly could. And they failed to do that anyway, but they created, in my view, a lot of damage on the way. And similar things are true in the US and in other economies
Yeah.
around the world. We put up with unnecessary underemployment and an unnecessarily low standard of living for years, because we misinterpreted the way the monetary system works.
So that's the cost of being wrong, of using the budget constraint as a useful political proxy for resource constraints, is that by trying to stick to the budget constraint, you have high unemployment for a decade and you miss opportunities to make investments that are there.
For 40 years, really.
And is there an error? I'm just trying to think about the reverse. Like, is it possible still to stick within your budget constraint, but then spend on a weird array of things, lots of imported goods, and then still have an inflation problem, even though you stick to your budget constraint? Like, is that
And
also possible?
you can have an inflation problem when you're running a budget surplus.
Yeah, right.
I mean, when inflation, when the inflation rate rises over time, the important thing is to think about what is driving that
Uh-huh.
inflation. At the moment, the main contributors towards inflation in Australia are the price of non-discretionary items. So something that you know all about, which is rents,
Mm-hmm.
but also healthcare costs, education costs. These are the things which have been driving the CPI
Mm-hmm.
recently. Now, raising interest rates or tightening fiscal policy, it's not obvious to me that
Yeah.
this is going to help when inflation is driven by those factors. So you need to think about, if those are the factors which are driving inflation at the moment, then what can we do about
Right.
those factors? What can we do to reduce our vulnerability towards inflation driven by those factors, and going back a bit further, driven by fossil fuel
Yep.
prices, and looking into the future, driven by climate change?
Yeah.
What sort of investments should we be making to build an economy which is more resilient, which is less likely to be faced with inflationary episodes driven by the sorts of things which have contributed towards our higher inflation over the last 3 or 4 years in the future? Those are
So
kind of questions we ought to be asking.
the mainstream response, I think, would be that it doesn't matter where inflation's coming from, because if you uh, raise interest rates or stop deficit spending, people will have less money, and if you squeeze people enough, they'll spend less, and eventually prices will come down. Like they will
Absolutely
say
right.
it doesn't really matter. Like it doesn't matter the source of inflation. We've got this tool that works regardless, because people have less money and that works itself out. What do you think of that?
Absolutely. If you reduce everybody to poverty, then you won't have any inflation. Yeah,
So
that's a great policy prescription.
I often say to that to people, you realize that our solution is to inflation is to make people have less money and put people out of a job. And, it's a trade-off, right? Like, I often say we've had the best labor market for decades in the last 2 years, but we've also had inflation, right? How is this not a better outcome than low inflation and 6 or 7% unemployment rather than 3 to 4, right? I still don't get that as a mainstream view. Like, why is 5% inflation bad if you can have a super hot labor market? Is there an MMT view, or what's your personal view sort of on?
I've got no problem with 2 to 3% inflation being a reasonable medium-term goal, but there's no
Uh-huh.
scientific validity behind that. It's
Yeah.
just that that sort of inflation rate is an inflation rate that people don't notice.
Yeah. So it
People
doesn't
don't
become.
like inflation, so it's
I've
not a
noticed,
political issue.
I've really noticed that I think I've often wondered what's the problem with inflation? Like, because if incomes are going up at the same time as prices, it should all just even out. We should get used to it. But what I've noticed is people think that when their income goes up, that's they did that, that's good for them. But when the price of something they spend on goes up, that's someone else's fault. And so they're like, I'm doing the right thing and earning more money, and you're punishing me by making prices going up, not knowing that you're just all part of the same economy and all prices are going up. So
Yes, this
how
is where we go away from rational
yeah.
economic
But
man, to use the generic term, towards behavioral economics
that's right.
and people who are not entirely rational.
And I think
Yeah.
until I had lived through this little inflation bout, I didn't realize how irrational the political debate becomes. When I'm just here going, this is just inflation. Like it's all prices, they're all adjusting, but everyone's in a panic as if my area is not inflation and your area is inflation and that's your fault. And I'm like, whoa, crazy debate. So um, I, I
We
do
haven't
want to,
had everything. We haven't got everything perfect since the pandemic,
yeah,
but we've basically gone through the four horses of the apocalypse in the last few years, and we've done pretty well.
I think so.
We are much closer to full employment than we were. Inflation is, I mean, it's not exactly mid 1970s inflation rates that we're dealing with
No,
or anything. It's really been under both sides of politics, you could
yeah.
argue, largely a success,
I think
the
then
reaction to the pandemic. It could have been much worse.
I think, yeah, I think macroeconomically, I'm surprised at how smooth this recovery has been, or how
We did it by
well.
mistake, of course. We did it by accident. They didn't do it on purpose. They engaged in that deficit spending because they didn't have any choice. And having spent years saying we've got to run a surplus, otherwise we won't have the money to react to if anything goes wrong, they then demonstrated that actually
Mm,
the level of government debt is completely irrelevant if something
yeah.
goes wrong. You're the currency issuer. You're always going to be in a position to engage in more deficit spending if it's appropriate to do so.
So, random question is Javier Milei, the new Argentinian president, thinks he's tackling inflation. Um, what are the insights from MMT that you could share with him? He seems to be cutting government deficits and firing the public service. It's a really weird experiment that's happening there politically. Um, how does an MMT lens look at problems of hyperinflation? You know, h- how do you stabilize a currency that's in this sort of inflationary process? Is there any insight there?
Hyperinflation is usually driven by the supply side of the economy, first of all, and then yes, governments deficit spending to react to
Yeah.
rising prices. So you have a similar story if you're talking Germany after the First World War, or
Yeah.
Zimbabwe in 2008, or whatever hyperinflationary episode you want to look at. If you are Argentina's issues with its socio-political system go back
Yeah.
over a century.
It's
Argentina has never had a successful democracy and has had crisis after crisis after crisis. There are similarities between although they weren't perhaps quite so crazy then, but between the 1990s and now. In the
Mhm.
1990s, without explaining what it is, so they tried a very hard peg fixed exchange rate
Uh-huh.
system called a currency board, which
Yep.
for a while helped them to bring inflation down in Argentina. But without going into details, it all collapsed in a terrible crisis
So,
round about the millennium. And my expectation with President Milei is he may well be able to keep inflation down, but it's all going to end in tears again
yeah.
because the basic social problems in
Mhm.
Argentina, the high degree of inequality, the high level of corruption, the lack of trust in governmental institutions are still there. They haven't gone away,
Yeah.
uh, and uh, there is an extent to which you can drive inflation down by driving people into, or a section of the
Yeah.
population to poverty, but it will end. At some point, there will be another crisis, and
Yeah.
he'll
Do you,
he'll, he'll be overthrown. They'll try something else. They've tried
yeah.
almost everything as
Do you
far as
think
the
it
monetary
requires,
system.
do you think dollarization is a good alternative in a dysfunctional system like that, just to constrain, because that automatically then constrains your exports and, printing money to import goods and things like that. Like it just offers a political constraint. I mean, is that a reasonable thing to do in your
Well,
view?
uh, uh, that's only one step beyond the currency board of the 90s. I mean, the trouble, first of all, you're making yourself basically a colony of the US if you do that. But secondly, your main trading partner is not the US, it's Brazil. A period of strength in the US dollar and a depreciation of the Brazilian currency is going to cause you major problems, which is
Yeah.
exactly what happened in Argentina the last time they tried this. At the end of the
Uh-huh.
1990s, the economy crashed.
So,
There was a revolution. They moved away from tying their currency to the US dollar. They floated the currency again. There had
mm,
been such a recession that they then enjoyed, well, it was made a little bit easier because their export prices were quite buoyant as well. But they
yeah.
then enjoyed a period of relative economic success, almost the only period of economic success they've had in Argentina for a century, in the years leading up to the global financial crisis, and
All
then
right.
gradually unraveled again after that. We're back in a sort of 1990s
Hmm.
scenario again. If you were Warren Mosler and you
Yeah.
were taking over Argentina, then you deal with Argentina's US dollar debt through having a tax on some of Argentina's exports,
Yeah.
where some of the US dollars that are raised are used to
Through.
service the
Yeah.
US dollar debt. You would use the power of the government as in as a monopoly currency issuer, but also a very powerful buyer or price setter
Yeah.
to cap prices. You would protect the ability of low-income households to buy basic necessities. But other
Yeah.
than that, you'd move radically away from the culture of indexing everything,
Yeah.
of
Yeah.
reacting to
Yeah.
price shock by automatically seeing the
Yeah.
price level increase. But I don't know whether you could do that without there being
The political consequence.
riots against.
Yeah. Yeah.
I'm not saying it's easy, but I don't think that what President Milei is doing is going to be a permanent solution as far
Okay.
as Argentina is concerned, because there are structural problems in that country, in that country's society,
Yeah.
which echo perhaps your own work in your book
Oh, yeah.
Rigged
Yeah.
in Game of Mates,
No,
but even more so.
I agree. But okay, so sorry, this is great conversation. I'm gonna just quickly, have you thought about Turkey? Because Turkey seems to have high inflation, but the economy is doing relatively well, from what I understand. Is that true? Is there do you see them differently? Are you following this, or are you just, you know,
I'm not really, and people like
okay,
Warren do.
okay,
I am not one of the leading MMT economists. I'm a
that's not
teacher
true.
and
You
a
are in
prevailing.
Australia.
Well, that's because there aren't any. Well, actually, there are, but most of them like to keep their heads down. So I won't name names, but there's
No,
five or six quite well
there's
known ones who don't do podcasts, don't go on the radio.
all right. So
There's really
you
just Bill Mitchell and me, and I started doing this because you can't just leave it to Bill Mitchell. There has to be more than
no, no.
one person.
Look, I think all those insights about monetary operations, they should be standard canon, right? In economics. I don't know why the textbooks, um, the stickiness of weird stuff in economics textbooks blows my mind, considering how politically important and culturally dominant economics is. So, what are you doing
It's
to
been the
change
same
that, Stephen?
story. It's
But
been the
you're
same story for 150 years. That's why it's so difficult to change.
but you're
A
actually
lot of it
doing
goes.
something to change that, right? Tell us about the
Um,
what you're doing
we're
and what.
doing the best we can. Yeah, you came to the conference in 2020, just before the
Mm,
pandemic.
mm-hmm,
I had the opportunity to invite Stephanie Kelton
mm-hmm,
over, the leading MMT economist.
mm-hmm,
So I did, and we organised a conference while she was here when I was at Adelaide Uni, and Stephanie and some others too, and a well-known fund manager called Con Michalakis asked
yep,
me to set up some courses at Adelaide Uni based on modern monetary theory because there was nothing available in Australia. Um, and so I tried, but like most university economics departments, Adelaide Uni, much though I love them, the economists there are quite conservative with a
mm-hmm,
small c, so it just wasn't possible to do. So, with Con's help, I left my job and set up a not for profit or a charity, which is where I'm sitting at the moment, Modern Money Lab. And we looked around for a university partner, and the universities that are headquartered in South Australia are
mm-hmm,
Adelaide and Flinders and UniSA, and none of them were really interested. But one of the two private universities in Australia, Torrens University, is also headquartered in Adelaide, and
uh-huh,
they were interested. And so, what we did over the next couple of years was we wrote some online courses, and we developed a graduate certificate, graduate diploma, and master's degree that covers not just modern monetary theory, but heterodox economics in general, and particularly ecological
mm-hmm.
economics too. And so for the last year and a half, we've been running this program, and we've got about 100 students around the world
Wow.
on the program now. And the amazing thing is, I'm very grateful to Torrens, and they're great people, but I'm sure they wouldn't mind me saying they're not exactly the University of Oxford or Harvard in terms of their international reputation. But these
Yeah.
classes, because there's nowhere else that you can learn this stuff, the students on these classes are like a seminar group from Harvard or the University of Oxford. We've got the most amazing students on the program. So this has been the best experience that I've ever had in 40 years of doing
Wow.
university teaching. And I don't regret it for a moment. And what
That's
we
true.
hope will happen is that places like the University of Adelaide and Melbourne and ANU one day will copy us and make us redundant. That would make me really happy if
And
that
so
was ever to happen.
Modern Monetary Lab, is this all online or do you do in-person events? How does it operate day to day? Like, is there an end of
We do
term
some in-person
meeting?
events, but it's the courses
It's all
are
online.
all online. We have
Yeah.
pre-recorded lectures, but we have also have live webinars that we have to do twice because we have to allow
For
people
time
to attend
zones.
wherever they are in the
Yeah.
world. Or some people get up in the middle of the night because they want to come twice to meet all their
Yeah.
fellow students.
That's
That's the
terrific.
kind of people that we've got on the course. Students from early 20s up into their 70s. We have government advisors, politicians, climate scientists, professional footballers, opera singers,
Wow.
all sorts of people on the program. And it's, as I said, it's been a fantastic experience. And because my colleagues around the world think that this is something worth doing, we've been able to recruit to teach with us some of the leading MMT economists and ecological economists. So there's some downsides to doing things online rather than
Yeah.
face to face, but an upside is I couldn't have a climate scientist from Honolulu with
Yeah.
a government advisor in Canberra in the same classroom,
Yeah.
and you can do that kind of thing online, and that's what's so good about it. The students have formed a a an intellectual community and
Mm.
formed connections with each other, which it's a great delight to see getting stronger and stronger.
That's
over
brilliant.
time. So this is evolving from coming out of my head, which is where the syllabuses came from in the first place, to something which is going beyond my control. And in a year or two, I'll probably retire from it. I think it's sustainable, and I think it will go on without me quite happily.
That's brilliant. And what's the URL for people to go and check it out?
Well, they could just
Modern Money Lab.
Google the Modern Money Lab site,
Great.
or you could also Google Torrens University
All right.
Economics of Sustainability. Either
Yeah.
of those, and you'll get to the courses.
Terrific. Look, I'm so impressed, Stephen, like your journey from teaching the textbooks to bankers in London, to learning about banking from all the old guys, to changing the way you taught economics, to starting your own modern money lab. I mean, what a journey, like intellectually and in terms of your own sort of teaching and sort of building that community. It's super interesting, and I loved getting into the details. Really appreciate your time, Stephen. We'll have to do this again sometime.
Thanks very much, Cameron. Great pleasure.
Thank you.